Okay, hello everyone. Thanks for tuning in to the weekend video edition of Traders Espresso for the week ending Friday, February 16th. So, U.S. equities on Friday posted their sixth straight day of gains. And although it was a day of gains, there was some evidence during the day that the bulls were starting to run out of steam and that the bears were starting to kind of pick up speed. So I'm going to show you a couple charts which I think demonstrate that, and then kind of take a zoom out view and take a look at what the daily chart looks like, so we can get an idea of what we may be dealing with for the coming week. Keep in mind that Monday is President's Day, so markets will not be open. So that gives an extra day for traders to plan their strategies. It also gives you an extra day of headlines to come out, which could push the market one way or the other. We just generally don't know. So as I look at the 4-minute chart from Friday, what I see is two things. The first thing I see is that there were two bullish price channels that were forming and then rejected. So this is the bears rejecting that price channel, pushing value lower. Okay. The other thing that I take a look at is a couple lines in the sand. So the green dashed line here represents Friday's opening price. Okay. And the red dashed line here represents what was going to be Friday's closing price. And actually, since I drew that as the closing price for that bar, not the opening price, let me just adjust that. That doesn't really change the chart. It just changes where it is. So the first point I made was bullish forming price channels. So we can see here that a bullish price channel was forming, with this being the bottom boundary, defined by this candle and this candle here. And then if we take it and just take a kind of a photocopy of that and push it up to the high right here, we see the price channel forming. So we were fine until about 10:45, which is 12:45 East Coast time, where price action pushed below it successfully and then managed to trade down, forming a new bearish price channel. But then what happened was a new bullish price channel started forming, defined by this low point here and then this touch point here, with this being the upper bound. And once again, in the last 4 minutes of trade, the bears managed to successfully push price below the bottom boundary of that price channel and push it all the way down to this 27.37 16 or 27.32 16 level, which forms the closing price. Okay, so that's point number one, is breakout of the price channel here and here, and then also taking a look at the opening and closing price, bulls and bears defending. So each green arrow here represents a situation where the bulls were able to successfully defend a test of that opening price. So the price pushed below and then closed above it here, pushed below and then closed above it here, pushed below and closed above it here, here, and here. So that's 4, or rather 5, touches and defenses. These red arrows represent a situation where the bears were able to push price, were successfully able to push price below what was going to be the closing price, which is basically where the bears and bulls agreed, at least at the end of the day, that's where value is. Okay, so they did it here, bulls pushed it below here, here, and here. So that's 4. Okay, now that's important because what we're going to do is we're going to go back and take a look at that same kind of analysis on the 9th. So the 9th was the first day of the 6th day of consecutive gains for the S&P. So let's move it back to the 9th and put that in focus. Again, the green dashed line represents the opening price for the day, and the red dashed line represents the closing price for the day. Okay? The bulls were able to successfully defend opening price 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 times. Okay? The bears were only able to defend the closing price once. Okay, but they were, however, able to successfully push price down. Okay? What that tells me, or my interpretation of that, is the bulls were able to successfully defend a line in the sand 9 times. Okay? They were able to defend against a push to value down lower here and push price back up above the opening price to have it close here, which is where at the end of the day the bulls and bears agreed this is where price action needs to be. Okay? The bulls only defended that closing price once, or only needed. So you could argue that they were so weak that they only defended that closing price once, or they only were able or only needed to defend that closing price once. Okay? I look at it from a different perspective, which is this is much more lopsided. Okay? There are 9 green arrows on this chart and only 1 red arrow. Versus if you look at Friday's chart, there's 5 green arrows and 4 red arrows, which tells me that it's more evenly matched, that the bears are getting more assertive, and there is an agreement also, there may be a capitulation that price on the S&P is overvalued. And I think the really compelling point there is the fact that there were 2 price channels, bullish price channels, that were forming and were rejected because the bears were able to push price down below those price channels. Not once, but twice. Okay? So that's, it for the comparison of those 2 particular days. Now if I look at the daily chart, and I put back up our trend lines, our long-term trend line, what we're basically seeing is a push up out of the long-term price channel here, which culminated on the 26th. All right, that was the day that inflation fears kicked in, and the next day pushed price lower. And we see 1, 2, 3 different downward price channels that were formed. Now, this downward price channel here has been violated, so we're leaving it on there, just for sake of the discussion. Okay, but the second price channel was violated on Friday. Okay, so push above and close. This first price channel has not been violated, not been tested at all. So this second price channel, it's interesting how it intersects the midpoint of the channel here, the downward trend line does, and it also intersects the lower boundary of that price channel. Okay, the first downward trend line intersects with the upper bound here. So as far as what I would look out for next week, I would look out for either value to push up here and test this level, or value to come down here, because it could very well, even though it's pushed above, it could very well be successfully pushed down and stay above that price channel as a trend, as like a trend line, or not price channel, the trend line. And then this is going to represent a key test here. If the bears are able to push price below that, then the next level to test is going to be here. Now, if the bulls were able to push price to a break above that long-term price channel, then 2 places to defend are going to be here and here. These are previous levels of resistance that are going to be resistance potentially next week. Okay, so that's what I would look out for next week. The other thing that we saw was a return to strength of the US dollar index. So if we take a look at, or if we buy into the fact that this is the long-term price channel, which if we go back, look at a weekly chart and go back even, before the Great Recession, right? This was the downward price channel that was forming, okay? That was rejected, and there was a push above. The price was successfully pushed back into that price channel, rejected once again, then it settled into it, and that was kind of the prevailing price channel until about 2014, okay? So since that was the most recent low of that price channel, that's where I start the Fibonacci, okay? The Fibonacci starts here, and it ends here with the most with the most recent high, okay? And what we see is that the bulls were able to successfully push the dollar out of that level, but the bears were able to draw a line in the sand here and push the dollar back into that long-term price channel, okay? The price of the dollar, the dollar bulls were able to successfully defend 88.45, which is the 61.8, which is a key level of retracement on a Fibonacci, and push it back up 1, 2, 3 times. Okay, that's the week chart. All right. So if we take a look at the daily chart, okay, we had 6 days here of gains, 6 straight days of gains, coming off of the Fibonacci, and then a push down 1, 2, 3, 4 consecutive days of dollar lower. And then the bulls drawing a line in the sand on Friday, and not only defending that Fibonacci level, even though it went below it, it closed above it. And then actually pretty impressive day of gains. It was 0.6%, so 0.6% dollar gain on the day. So it's still down for the week, but a gain on the day. So I take a look at that as evidence that dollar bulls have regained strength. They're going to defend this level next week, so I'd watch out for that this week. I think that the yield on the 10-year note is probably going to bounce around where it is right now. It may test the 3% handle. We don't know. But I don't think it's going to go considerably lower, especially not in the face of dollar strength. The other thing that I find very interesting is the fact that the dollar was higher, but even though the dollar was higher, commodities almost across the board were higher, and safe havens were higher. Now, safe havens are, when I look at like the gold futures, like gold is a dollar denominated asset, okay, so but it was still higher, all right. Looking at the futures for the Swiss franc and futures for the yen, okay, dollar was up, those futures were still up, all right. But if you look at the yen and the Swiss franc against other currencies, they were stronger against even other currencies like the euro, like the British pound, etc., etc. And if you compare the franc to the yen was actually just a little bit stronger. So the yen had the edge. So the story that tells me is if commodities are higher, oil, with the exception of natural gas, oil's higher, copper's higher, industrial, like copper's an industrial metal, are higher. Okay, that tells me that the market has confidence in the global reflation story, because those commodities are higher, including soft commodities, which are agricultural commodities. That's number one. And then number two, the fact that safe havens are higher in spite of dollar strength, which often at times is a flight to safety in the face of market turmoil. I also throw in there that the VIX is below 20 but still elevated. Okay, I don't think that we're out of the woods yet when it comes to potential turmoil in equities. So I'm going to leave you with that thought. You've seen the charts. You can formulate your own opinion, but now I've taken you through how, kind of what I'm looking at and why I am interpreting it the way that I am. And, we'll see how things shake out next week. All right. Thanks for watching, everybody, and I hope to see you on Tuesday. Enjoy your President's Day holiday and your extended 3-day weekend. Have a great one, folks.